Hello everyone, welcome to our Egyptian online seminar group. First, click on resolve. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming Professor Stephen Penman. Stephen Penman is one of the top accounting thought leaders in the world. He is a professor emeritus and special lecturer in the Graduate School of Business, Columbia University. He is also a professor at Bocconi University. Penman earned a first-class honor degree in commerce from the University of Queensland in Australia and M.B.A. and Ph.D. In accounting from the University of Chicago. His research is concerned with the valuations of equity and the role of accounting information in security analysis. He has published widely in finance and accounting journals. He has 3 books on financial statement analysis and value investing. He is a member of the Financial Economics Roundtable. Penman has won numerous awards, including the notable contribution to accounting literature, and the Wildman Medal for his books Financial Statement Analysis and Security Valuation. He received an honor doctor from the Stockholm School of Economics. He was awarded with the Innovation in Financial Accounting Education Award by the American Accounting Associations and Lifetime Achievement Award from the American Accounting Associations. Penman was inducted into the Accounting Hall of Fame and in 2020 into the Australia Accounting Hall of Fame. Now we will start our seminar with the Professor Stephen Penman.
Okay, thank you very much, Mohammed, for that introduction, and thank you for inviting me to join you today. And thank you all for joining with me. This paper is joint with Christina Dagenadou, University of Exeter. For those of you who attend our accounting design project, which is every second Tuesday, largely during semesters, you'll understand that one of our themes there is design, taking research and putting it into design products that can be used in practice, the basic research to practice mode. And this paper is very much in that mode. It's taking research that I and others have done to reconsider financial statement analysis and add to that financial statement analysis. The paper the analysis is very much in the context of using financial statement analysis for valuation, particularly equity valuation. That, of course, is not an innovation. Of course, there are many papers that have looked at financial statement analysis, not just as a historical document of what generated the profitability, but for forecasting future profitability that's relevant to valuing equities. Of course, it's in the standard textbooks. So what we're doing here is simply adding to that, embellishing on that. So what are we doing? Well, let's state the standard accounting-based valuation model, sometimes referred to as the residual income model, where the no arbitrage dividend discount model is restated in terms of book value and earnings payoffs. That, of course, leads us straight into the financial statements. And this, of course, is the model that's applied in those papers that are referred to that apply financial statement analysis to valuation. I've indicated the numerator here in terms of ROE. Technically, it should be expected earnings relative to expected book value, but this shortcut is helpful because ROE, of course, is the premier top line financial statement analysis variable, return on equity. Typically, that financial statement analysis that's in the textbooks, in those papers I referred to, they're about predicting the numerator. How can I use the financial statement analysis to predict what the return on equity is going to be next year, the following year, and so on and so forth? And the students go ahead, they decompose ROE, they pull out their spreadsheets, they look at sales, they look at margins and so on, and they get some estimates of what that is going to be to insert into this valuation. But what about the denominator? The denominator is R, which is the required return, the expected return, the cost of capital. What about that? For many years, I taught financial statement analysis, and I said, listen, we can deal with the numerator here, forecasting the numerator, but I can't tell you much about R. Go over to your finance professor. He or she might be able to tell you. Best of luck, because I actually haven't worked it out yet. But it was always a cop-out. So that has always has worried me. And so what we're doing here is asking, can we develop a financial statement analysis for risk, the discount rate? So the standard financial statement analysis of ROE says, so first of all, you've got to deal with leverage, because ROE is determined by leverage. And there is this deterministic leveraging equation, which is very easy to apply. There's no error term. It's deterministic. It's made up of the profitability of the operations, which is the operating income from the business over the net operating assets, plus a premium for leverage, the amount of leverage, net debt to equity, and the operating spread over the borrowing cost. That's easy to apply. We can do that. We can get rid of leverage, and typically we say, let's get rid of leverage and let's focus on the RNOA. And so much of the financial statement analysis has to do with actually getting information from the financial statements to predict future return on net operating assets, RNOA. But what about the risk to RNOA? That's the thing that's been bugging me, and that's the thing that we're missing in our standard analysis. Well, the standard analysis says, well, we start with a decomposition known as for a long time as the DuPont decomposition, where the RNOA is determined by your operating profit margin, OPM, and your asset turnover. That is, the more operating profit you get from $1 of sales, and the more sales you get relative to net operating assets, the higher is going to be your RNOA. And that gives you your basis for forecasting the future profitability. Can we actually then take this and modify it to deal with risk? By the way, Mohammed said, if you have any questions while I'm presenting, raise your hands, okay, if we can deal with those. We'll have a Q&A session, 15 minutes at the end, if you prefer to defer your questions to them. But please interrupt any time and let's have a conversation. Okay, so to get hold of this, we've got to think about accounting principles. The paper has the financial statement analysis. It has a lot of empirical tests about to see whether it actually works, which is affirmative. But I think I want to make sure in this session here that you get the thinking behind it, that this is not just, here's a cookbook for doing it, okay, but you understand the thinking behind it. And that's the most persuasive thing to be assured that what's going on here has some integrity. Okay, now that residual income model, so-called, actually is empty. How we get that is we take the dividends in the dividend discount model and we substitute earnings and book values for dividends, given that the accounting is clean surplus accounting. We use the clean surplus accounting relation to do that. Now, any theorist will tell you, pure substitution doesn't put anything on the table. And we have to recognize that it doesn't tell you anything about how the earnings and book value are measured. And we know in accounting, we can do different types. We can have fair value accounting. We can have historical cost accounting. We can have various forms of historical cost accounting. But there's nothing in the residual income model. People latch onto it, insert GAAP or IFRS earnings in there. But no, in the model itself is actually empty. Indeed, it actually tolerates random numbers. And the only reason why it ties up to the dividend discount model is that even if you have random numbers, in the liquidating dividend, you've actually got to get the book value to zero, okay, when the firm liquidates, and that forces, in the last period, that forecasts the equivalence to the dividend discount model. I don't think that's well recognized. So in terms of thinking about valuation, accounting and valuation, we have to think about, how do I do my accounting? And particularly, how am I going to do my accounting for the in the DuPont decomposition for the financial statement analysis. Now we have a little trick with these models. So, okay, substitute in, and we have this transversality condition, okay, that actually dividends in the end are all paid out, okay? And that's supposed to have saved us. But actually, as I said, random numbers actually work. Okay, so we're talking about the return on the business, which is the operating income relevant to the investment. And the way we typically think about this, as an economist would think about it, is the sort of the rate of return on investment, the economic rate of return, or sometimes referred to as the real rate of return. In the numerator, we have the return from the investment relative to the investment in the denominator, and that gives us a percentage return on investment. Now, how does accounting work? At least our accounting that we have under US GAAP and under IFRS, we don't quite do that. And in fact, in modern times, we don't do it to a large extent, because rather than putting some investment in the denominator, we put it in the numerator. R&D is an example, okay? And many other expenditures to generate profits are in the numerator. We confound, the accounting confounds earnings in the numerator with the investment to get earnings. That seems to be very, very odd, and it's seemingly odd, but it turns out it's because of accounting principles. There is method in the madness here of actually putting investment in the numerator and not including it in the denominator. So let's talk about those accounting principles. So it's important to understand this, that there's a particular accounting going on here that's going to help us in our financial statement analysis. First of all, we have the realization principle. Now, forget fair value accounting, okay? That doesn't do it. In fact, that violates these principles. But under your standard historical cost accounting, which is largely the accounting for non-financial institutions, non-investment funds, and so on, okay? We have the realization principle. And that says, listen, you cannot recognize revenues and the earnings from the revenues until you get a customer, and the customer has shows the ability to pay. Under IFRS 15, we have the revenue standard, okay, along with the very similar US GAAP standard that says, actually, you've got to get to a situation where you've got a customer, contracts have been performed on both sides, and it says receipt of cash is highly certain. You can't book it before that. Now, if you're buying a stock, you can think, I can base my price on what the expected earnings are going to be, okay? And of course you've got to do that. But the accounting says, actually, if they're not been booked yet, they're still at risk. They're only released from risk when, in fact, you get a customer. They're still at risk. That customer may not turn up. And so the accounting has implicit in it that future earnings are at risk because they're not realized. Now, that's very important to understand, I think. I believe that's very instructive for us when we think about accounting. You may expect future earnings. You may book them. You may buy them when you buy in price. But just keep in mind, the accountants are telling you, hey, you're taking on risk. The other principle, which is particularly relevant for the financial statement analysis that we're designing here, is a conservative accounting principle for assets. And this is the method in the madness when we look at the accounting book rates of return. It says, look, if the investment is particularly risky, you can't book it to the balance sheet. If you've got inventory, you can probably sell it tomorrow, book it to the balance sheet. If you've got a plant producing that inventory that you probably can sell tomorrow, book it to the balance sheet. But if you're investing in R&D, that's by degrees more uncertain. We're not going to let you book it to the balance sheet. Now, reports tell us that actually, on average, about only 10% of R&D pays off. Okay, it's highly risky. And the accountant says, I'm not willing to put that on the balance sheet and pretend you have collateral. Mm-hmm. We know from startup biotech, startup tech firms, they cannot borrow. Banks will not lend against debt. They have to be all equity finance. And the accountant said, I'm not going to put that on their balance sheet and pretend it's a similar asset to inventory or property, plant, and equipment that gives you collateral. You've got to expense it immediately. That, of course, is conservative accounting, or more strictly unconditional conservative accounting that's been talked about in the literature for many, many years. I see Paul Zaron with a hand up, so take it away, Paul.
Yeah, great stuff. Just a quick question. So, the IFRS rules, there's kind of almost a continuum, and there's a threshold point at which you can capitalize, not just say can, according to the rule, you're supposed to capitalize R&D. And I think in that case, the rules are, I'll use the word conservative. In other words, a threshold you have to meet. Yeah, of course, it can be gamed. I don't know if I sent you the most recent version of my paper with UK data, but I found that once they started to capitalize after IFRS, there were very few write-offs. So it may be special to the period, I don't know, but it seems like IFRS creates a conservative enough situation that you wouldn't have this problem.
Well, I totally agree. And my inclination, based on the work and some of your work, is that the IFRS accounting dominates the US accounting in the sense to say it's not all highly uncertain. Once you get to a certain point, and I believe there's five criteria, 5 milestones in IAS 38, then you can actually capitalize on the balance sheet. That is they call development. Research you cannot. Okay.
So you're comfortable with that?
I'm comfortable with that.
Okay.
And the continuing research is indicating that establishing that threshold, but just note that the same principle applies. If you get to a point where actually it's likely to pay off, the probability, the uncertainty has been reduced, it's likely to pay off, then you can put on the balance sheet. So it's entirely consistent with the conservative accounting for assets.
I just wanted to be sure. Okay.
Yeah.
Thank you.
So here's the list of them, and in the modern corporation, of course, it's quite a big number. There's R&D, or as Paul says, there's R under IFRS. Brand assets, advertising, promotion, we can't put that on the balance sheet. Hey, they may not sell the product. Okay, there's uncertainty. Investment in supply chain and distribution systems, investors in customer loyalty programs, investment in human capital, you can't put that on the balance sheet. Hey, you're investing in employees, they may actually get up tomorrow and move to the competition, okay? Which all these AI people are doing now, okay? So, and some software development, although they're looking at now. And here are, of course, I've indicated on the slide the relative authoritative documents, FAS statement number 2. There's your IAS 38, but it says you distinguish, as Paul said, R&D due to the probability of future benefits. That's what IAS 38 says. And so this is what we do. And but the key thing here is that when we do this as accounting, yes, we're messing up that measure of return on investment, but we're conveying information about the risk. You invest in property in R, only 10% pays off. Put on the balance sheet, you're going to have a write-down, a high probability. And as Paul Zarowin just said, no, D, the D they're putting up, there's very little write-downs according to his reading. So this is how it works. So basically, there are two principles which actually are conveying risk, and that's very much pertinent to what we're trying to do here. Okay, let's look at those, use those principles to understand how we can extract risk from the financial statements. Paul Zarowin again.
Yeah, sorry, Steve. One more question. So you said you're comfortable with this split between, let's say, R and D, and when the threshold is passed with D, it could be capitalized. Why do you think in a place like the United States, which is supposed to have the best accounting, very sophisticated, et cetera, there's such a reluctance to do any capitalization? Do you have any thoughts on that? Why there's such a reluctance?
I have no idea on it. I have read, however, in Europe that a lot of firms are not capitalizing D. Okay, they're preferring to not expense it. Okay, even though there's indication they're meeting. So there seems to be a reluctance. Let's say there's a desire to be conservative. Okay, in the presence of risk. And so that would be my explanation. Okay. There may be political explanations as to how the FASB works, but that would be my guess at it.
Okay, thank you.
Okay, so here's standard interpretation of RNOA. When RNOA is greater than the cost of capital R, that indicates profitability. You're covering your cost of capital. Is that correct? Well, with the method, the madness of the method of accounting, it's not correct. RNOA itself conveys risk. If, in fact, you've got conservative accounting and you're depressing that numerator, you've got a very low RNOA, but that conveys risk. So low RNOA is not a measure of bad profitability, of return on investments, an indication that you've got risk because of this accounting. Now, if in fact you expense that, R&D or one of those other things, brands or the supply chain development and so on, then the asset is off the denominator. So if in fact you get the realization, you get the customers and it pays off, you're going to have a very high RNOA because now you're going to have the payoff to the investment without the investment in the denominator. And so this suggests to you that RNA is actually negatively correlated with the risk. A low RNA indicates, if it applies to conservative accounting it implies higher risk. A high RNA applies lower risk. So that's the key that's going on here, okay? Remember, it's RNOA, return on net operating assets, which we in fact want to analyze in our financial statement analysis. Okay, now, Penman, you're just babbling on, okay? Is there any authority for this, okay? It looks like accounting is driven by risk. The more I think about accounting, we usually think about accounting conveying information about the future cash flows, about the numerator, but when you think about it, as the accounting evolves, it's actually revealing risk. Yes, you're investing in these risky investments, you're risky. Yes, they're paying off, you've got the resolution of risk. So the progress in the evolution of the financial statements track that risk. So I'll give you the theory, okay? There's a paper by myself and Chaojung Zhang at Berkeley in the Journal of Accounting and Economics, JEE, back in 2020, which you should really get into, because this shows that both analytically shows that the realization principle and the conservative accounting investment conveys the discount factor in a general no arbitrage asset pricing model. Take that generalized arbitrage no arbitrage asset pricing model with covariance risk, run it through, and you get the connection. So actually, it conveys price risk. It's a very nice paper. Now, the empirical validation, again with Chao Jung, the paper here in Review of Accounting Studies, then actually goes and gives you some tests of this, okay? Low RNOA under conservative accounting conveys risk in terms of many risk measures, including betas, including variance, including outcomes. And there are many other papers, a number of other papers of which I've been involved in with co-authors in this paper that give you the further documentation. So this is not idiosyncratic risk, and the accountants just messing around in their madness. This is actually conveying priced risk. A further application is the Penman and Jew paper, which is again in the JAE, which builds a factor model in the style of empirical finance, builds a factor model based on these principles, and it beats the pants off the Farmer and French and most other factor models in finance. Okay, so with that assurance, here's an overview. I have a monograph here, which gives you a complete overview of the whole analysis here. So with that background, and with the assurance that what we're getting here is really getting a handle on risk under these accounting principles, let's now proceed to the new financial statement analysis. The title of the paper is Towards a New Financial Statement Analysis, because there's aspects of the financial statements that aren't dealt with here. So it's basically a matter of modifying the operating profit margin. So the point of departure, of course, is the recognition that operating income commingles expenses to generate current sales with expenses which are to gain future sales. That's the investments going into the numerator of RNOA. Operating income is what we're going to call match profit. Current sales, revenue, minus expenses under the matching principle to actually generate profits from the revenues. But then it takes off these mismatch expenses, the ones we've talked about under conservative accounting. And of course, there's also income there in the income statement, which is not from sales. Unrealized and realized gains and losses on securities, write-downs, and so on. Okay, we're not dealing with the third component here, the income not from sales, and that's partly why we call this Towards a New Financial Statement Analysis. So, so in terms of the DuPont composition, we then have operating profit margin as matched profit relative to sales. These components all deflated by sales, mismatched expenses relative to sales, and income not from sales relative to sales. Now, a little bit of math produces what I think is a very interesting representation. We can write that down as matched profit to sales. You call that the match profit margin. Okay, that is the profit margin from current sales multiplied by a multiplier, which is 1 minus the amount of match expenses relative to the match profit. And so we have three components here in the financial statement analysis. We have what we call in the paper match profit margin, sales minus matched expenses to sales, which gives you, this is what I'm making from current sales. Now think of a company like Amazon for many, many years was reporting losses, up to 2014 reporting losses. They say, well, it's unprofitable. I'm not going to invest in it. Well, that's not quite right. If in fact you looked at what they're making from the current sales, they had pretty good profit margins. It was just that they were actually developing investments in to gain future sales. But now that part of the income statement of the profit margin is indicated by a multiplier. That's 1 minus the amount of matched expenses over matched profit margin. So the higher the matched expenses relative to the matched profit, the lower the multiplier here. So it's sort of like an inverse multiplier. And that's what we call the matched expense multiplier. And that's this is just a matter of a little bit of math, but it actually highlights we have a multiplier here which actually multiplies the matched profit you're going to earn, okay, for the future. And of course, we have the final component, which is the income not from sales. We ignore this in the paper, but actually most of them are mean zero. Gains and losses from equity securities, impairments, and so on. Typically, they're not predictable, but this is something we're not concerned about. Okay, so this multiplier, it has the properties of a multiplier. It indicates, because you're investing in this, in these net expenses, it indicates higher expected profits in the future. Yeah, if you're doing R&D, presumably they're doing it to actually get profits in the future. And so you got the multiplier effect that you're actually going to add to your current match profits. However, it also has the feature of these profits are at risk, because under the accounting principles, you have these mismatched expenses, these mismatched investments there, because they're highly uncertain. The probability of payoff is relatively low, okay? Now, that's just the problem of a multiplier. You think of the basic PE ratio with a little, if you allow me, this little valuation model. Price now is just forward earnings over R minus G. Then the forward price earnings multiple is 1 over R minus G. You can see growth there. If I get growth, I'm going to increase the price, it says, provided, of course, that it's not risky. But I have risk also there. So if it's risky, the R is going to increase also. So a typical multiplier, both R and G, growth and risk are involved. And that's what we're trying to, well, that's what this multiplier here is conveying. And that really becomes the prediction for our empirical work. Does this multiplier, empirically, this multiplier, as we calculate it in our financial statement analysis, does it actually, on average, project future higher profits? And does it project the risk to those profits? That's simply the empirical work here. So the financial statement analysis is not very, it's not very sophisticated. This multiplier here is, but the thing is, it identifies this multiplier, this aspect that in the financial statement we extract a multiplier that actually projects into the future. But it conveys both risk, both expected profits and the risk of the profits. Okay, now we've also got to add in the asset turnover to get to RNOA, and we could go on about the risk that and return that the asset turnover can convey. So, for example, if you've got a lot of sales on low net operating assets, because the net operating assets don't have the expense intangibles on it, then you might be less risky. But that's not the purpose of the paper. The purpose on the paper is to deal with this multiplier, the amount of which is determined by the amount of expense investments relative to match profits. So, as I said, here are the predictions. We take to the empirical work. Higher mismatch expenses relative to matched expenses convey higher future profits. But they also convey the risk to the future profits. And the second aspect of our empirical work is that this is price risk. It shows up in terms of expected returns, stock returns, and the risk to expected stock returns. So that's the analysis and the predictions. Again, harking back to what I said at the beginning, this is a design project. We're designing an accounting based on our understanding what the accounting principles. And then with that design, we're taking the predictions to the data. So just some intuition. Think about a ratio of R&D to sales. Now, I think you probably pretty quickly tell you that probably tells you something about risk. If you've got a lot of R&D and very few sales as yet, you're probably more risky, okay? Whereas if you've got R&D and you're generating a lot of sales, you're less risky. The first case would be a startup biotech. A lot of R&D, maybe no sales as yet. Versus a mature pharmaceutical, where you've got R&D, but you're getting the sales for R&D. The latter company, the mature pharmaceutical, our intuition would suggest is less risky, and this metric will pick it up. Now in the multiplier, we're talking about the mismatched expense to the matched profit, and that, of course, is just that ratio R&D to sales multiplied by sales to matched profit, okay, which is the matched profit margin, okay. So that gives you the lead in. Yeah, I can see this. Hope you're saying to yourself, I can see this. If they're not getting much sales, or they're not getting much match profit relative to the R&D now, then in fact it's probably risky, and that's what the financial statement analysis uncovers on a broader expense investment basis. Okay, now I want to refer back to asset pricing theory. Notice that in our predictions here, we're predicting that we're actually going to have this expense investment indicates high profits in the future, expected profits, but also the risk to profits. Now, if you go back to your basic asset pricing theory, think of the CAPM. You go back to papers way back. This is Lintner, one of the germinators of the CAPM. Not well recognized that in the CAPM, we think of risk as given to us by the beta, okay? That's commonly said. And the discount rate is given to you by the beta. That's not true. Lintner and later Farmer in the Farmer and Miller textbook and the Farmer textbook refers to the Lintner ratio, or sometimes referred to as the Lintner-Farmer ratio. And that says that the discount rate under the CAPM, and it does generalize to much more generalized asset pricing models than the multi-period asset pricing models under the CAPM, consumption-based asset pricing models. It's the covariance of the payoff, the one-period payoff, as a CAPM as a one-period model, and the return on the market relative to the expected return. What we're doing here is we've got a financial statement analysis that actually predicts the expected payoff, the denominator there in the Lintner ratio, but also the risk for those payoffs in the numerator, okay? If you go back to that, so the financial statement analysis, it's not a separate analysis for the numerator and the denominator. It actually brings in both, which is accordance with theory that the discount rate is actually not just based on the covariance, the beta, but also on the expected payoff. And the way to think about it is, hey, listen, it has a beta of 1.3, okay? The expected payoff is 50. Another firm has a beta of 1.3. The expected payoff is 3. Which is more risky? Well, your intuition says the one that's expected payoff is 3 is more risky, okay? The one which has expected payoff of 50, it's less risky. That's what's going on. I was delighted when we worked on the Penman Jung paper, and it was Chow Dung who ground a lot of that through, that actually when we connected the accounting principles to the discount factor, in accounting terms, this Lintner ratio showed up, okay? as the basis for the discount rate in terms of accounting principles. So just notice now what we're doing is not dealing with the denominator, separate from it, we're dealing with both. And so we have a comprehensive financial statement analysis for valuation, because valuation is about the numerator discounted with the denominator. And so we've got a comprehensive financial statement analysis for the for valuation. Okay, now you with me? Raise your hands if you've got any issues here or questions to ask. Here is we come now to the empirical test, they're pretty straightforward. I think in the paper we can simplify the presentation somewhat of the test, but I'll take you through them. Here's your data. It's from 1975 to 2017, though we have a payoff period for 4 years after that, so the data goes up to 2021 with the payoff period. Financial firms and utilities, financial firms have got this fair value accounting. They're not there, okay? You don't really think of those in terms of profit margins and asset turnovers. So you're thinking much more of your retail, industrial, manufacturing firms. And of course, you have to admit some firms with some missing data. Stock returns we look at are stock returns for firms for beginning 3 months after the fiscal year end, by which time the financial reports are required to be emitted by law, held for buy and hold returns held for 12 months. So they're annual stock returns. Okay, oops. Now, our target variables. This is what we're going to predict. And we're going to predict both the payoffs, expect the average payoffs, and the risk for the payoffs. And what we're going to do is, again, we're going to pull up our residual income model, but now the leverage is out of there. It's just the enterprise valuation, or the value of the operations. And that is the book value of the operations, net operating assets, plus the residual income from the operations, operating income minus a charge against the net operating assets. We're going to accumulate over 4 years, 1 to 4 years. Okay, so you can think about, now it turns out a little bit of math will take you to this second expression here, where this expression here is equal to the sum of the operating income with the free cash flow that's generated, reinvested, all capitalized by the T period required return. If you want the math of that, it actually is in an appendix 3, I believe, in the original Olson paper, 1995, okay, on a levered basis. And so we're going to take that, but of course, there are mismatched expense to be incurred too. The financial statement, again, is just going to be predicting this part here, we're not into predicting what the future mismatch expenses are going to be, which would be an embellishment of the financial statement analysis. That, under theory, for period T, equals the value of the discounted cash flow valuation as T goes to the limit here, provided we have this wretched transversality condition. Okay, so the target variable is for 1 year ahead, 2 years ahead, 3 years ahead, 4 years ahead, accumulated match profit plus reinvested cash flows. Okay. Now, as free cash flows are operating income minus the change in net operating assets, this actually produced the future investment in net operating assets subsequent to that gets the match profit subsequently, which is a very nice feature. Now, we have a second target variable, which is just, forget about the free cash flow. We'll just take a look at the match profit relative to net operating assets. So both of these target variables are denominated in the current net operating assets. So this is the future profits relative to net operating assets. So it's actually it's future return on net operating assets from matched profits. And the idea, of course, that the investments in the mismatch expenses, they're ultimately in expectation, they're supposed to give you match profits. Okay. You're going to get the customers and you're going to have expenses in getting the customers. So these are the two target variables in the analysis. Unfortunately, we realize now reporting both these target variables, it makes it more complicated. We'll probably, in revision of the paper, just report one of them. Okay. So here are your prediction variables. Well, here's the match profit. It's the appendix of the paper gives you all the detailed calculations of the variables. The prediction variables, which are those that are going to predict the future payoff, the target variables, are match profit, which is operating income before tax. We forget the taxes because that has nothing to do with trading with customers. Plus the mismatch expenses, plus the operating income not from sales. The mismatch expense is the advertising expense plus the R&D expense. Plus, now we understand that there is a lot of mismatched expenses. These investments, these intangible investments, are in SG&A. So, like slaves to the literature, we're going to take a third of the SG&A, which is standard. Okay, don't like it at all. Okay. Let's take it just a third in the cross section. But what we're going to do then is say, actually, the advertising expense and the portion of SG&A, which we estimate, we're going to call quasi-matched expenses. Advertising expenses is quasi-matched because some advertising expense is generating sales in the current period, and some is generating sales in the future period. And so with all these other investments in human capital and all that sort of thing, some of it may generate matched profits now. Okay, so that's the way we deal with this quasi-match expense. Now, it turns out this is one of the big difficult. Write to the FASB about this, or the IFRS about this. SG&A covers in a multitude of sins. They don't tell you a lot which is in it, what's in it. Okay. It'd be very helpful if, in fact, we had more detail on SG&A. How much is their investment in human capital? How much is their investment in developing supply chains and customer loyalty systems and so on? This would be very, very helpful for our financial statement analysis and for our assessment of risk. How much of SG&A is current expenses to generate current sales, and how much of it is to generate future sales? I think that's something we should get onto them about. Mm-hmm. Okay, now here are some descriptive measures. You can see, let's go look at the medians here. The operating profit margin is on average over these periods. This is the means over all this period here. The medians is at 6.3%. The match profit margin is 15.4%. Okay, which means, of course, that the matched expense component here is 9.1%. Okay. So 9.1% of sales is actually, on average, is actually not expenses to get generated sales. Now, in the paper, there is graphs here showing how this changes over time, and actually the mismatched expense component has got much higher in later years, more recent years, where firms investment in assets is much more in these so-called intangible assets. The mismatching multiplier is about 0.5, okay, at the median, which tells you that the matched expenses to match the expenses to mismatched expenses to match profit is about 0.5, okay, because it's 1 minus that ratio. Of course, there's variation across firms. The variation which we seek to exploit, which is given to you by some more of that variation data here. I'll jump over the correlations. I just noticed that match expense to sales is positively correlated with match profit margins. So firms with higher match profit margins tend to have more matched expenses, which makes sense. They're making money now. Let's invest more in these to get future sales. Okay, so that brings us to the empirical test. I will look at these in some detail. At some point, I'll go through it more quickly just to leave time for Q&A. So the empirical tests are of two sorts. First of all, we want to deal with predicting future profitability. That was our two target variables there that I went through. Okay. Does this enhanced financial statement analysis produce future match profits relative to current net operating assets? That is the contribution of match profits in the future to RNOA. And does it predict the risk? To complement that, we have returns, because yes, if this is price risk, this should show up in returns. Do stock returns, stocks price to yield returns that compensate for the risk that the accounting is conveying? Okay. So does it predict stock returns? If there's higher risk, there should be on average higher stock returns. Does it predict the risk to returns of not getting the expected returns? So that's the second set of tests. Now, there's two sorts of tests that for both predicting future profitability and predicting future returns, there are two types of tests. There are portfolio tests, which I really like. These are tests in real time. If an investor had in real time in the history informed portfolios based on this financial statement analysis, would they experience different payoffs and different risk to payoffs, and different returns and different risk to returns? Okay, I like portfolio tests because they're real. They're what investors can do, conform in real time. But the regression tests, we tend to be a bit hooked on regressions in our business, because the first thing we do with the PhD students is push them into an econometrics course, and they're told to run regressions. But regressions have some problems with them. Okay, there's linearity, and actually it's very hard to translate that to actually the returns that an investor practically would invest in. They do have the feature of holding one variable constant at a point while you vary the other variables. Okay, and but I think regression tests are overrated. But we do run both, because a reviewer is going to say run a regression and give me your T statistics. So we run both. Okay, so for the portfolio test, first of all, we can take we start with the standard DuPont analysis of profit margins and asset turnovers. But the profit margin now is the match profit margin, okay, that you're getting from current sales. And we rank firms across the rows here in terms of match profit margins from low to high. And within each of those portfolios, we rank on the asset turnover. Okay, so that's the sort of basis to say, what does actually isolating the match profit margin along with the asset turnover, what does that tell you about the payoffs? Then, and by the way, we call that level 2, strangely enough, it would seem, of our analysis, because level 1 will just simply be ranking on the profit margin, match profit margin itself, without the asset turnover. Okay. Level 3 is then we introduce the mismatching from low mismatching to high mismatching. That then observes what the profit margin and match profit margin and asset turnover tell you, holding the level of match mismatching constant. But it also introduces a very high profit margin asset turnovers along with high mismatching relative the same thing with low mismatching. And perhaps the most definitive test in this portfolio design is now within these this is just directly to the multiplier. Within these match profit margins and high profit margin portfolios, we rank within the portfolios on the multiplier, okay? On the multiplier, and ask whether holding then the match profit margins and the asset turnover constant, whether now the multiplier actually discriminates on future payoffs and the risk of the payoffs. So that's the design of the portfolio test, and they all fit into that design. So the first thing we're doing is predicting future profitability. So there you are, it's the level 2. Now we've got two sides of this here. Now, this is target variable number 1 with the reinvested free cash flows, which is the reinvestment in the net operating assets. And this is without the free cash flows, without the reinvestment, the target 2, the second target variable, okay? Now, the results are very similar for both. I'm sorry to tire you with both of them. We probably should just report one of these and say, look, it's very similar. So if you want, just look at the right-hand part of the panel here to give you the indication. Although on my computer, all your faces, our galleries over that part of that panel. So you may want to look at the left-hand panel. Okay. So you can see here that in terms of payoffs, this is just standard financial statement analysis. High profit margins and high asset turnovers now indicate you're going to get a lot of match profit in the future, okay, relative to the low profit margins and asset turnovers. That's your standard DuPont analysis, okay, with these things used jointly. And if you want a Z statistic, by taking this one relative to this one here, and similarly over for the target 2 variables, that's very, very clear, okay, and that justifies in some sense our financial statement analysis of the numerator. But of course, our primary investigation is in terms of the mismatching, and so now we're looking at the mismatching within the same thing within low mismatching, medium mismatching, and high mismatching, and within those you get the same results for the match profit margin asset turnover. But the difference between this number down here in the corner and this number up here with the low gives you a significant Z statistics. But this is the one I think which is most instructive. Within each of those match profit margin and asset turnovers, and remember we're taking that match profit margin and multiplying it by a multiplier, bringing in the asset turnover. You can see that now within each of those portfolios, ranking on the multiplier, or actually the inverse of the multiplier, then we get significant differences from almost all portfolios, showing that given I observe my match profit margin now and asset turnover, if I get this expense investment, that tells me actually I'm going to have higher profits. Oh, by the way, I should say, the results here are for 4 years ahead. This is the cumulated match profit over the next 4 years, okay? You say, oh, what about survivorship? Well, we've got a table at the end. We'll come back to that. But we do it for every period: 1 year ahead, 2 year ahead, 3 year ahead, 4 year ahead, and we get similar results. And here's the regression test, okay? Match profit margin, asset turnover, and an interaction. Add the matched expenses, and you can see that predicts the future payoffs positively. Distinguish between R&D to sales, which is explicit, versus these quasi-matched, okay? And both the R&D and the quasi-matched give you that prediction. Where the quasi-matched there, of course, is there because we're worried about this taking a third of SG&A But R&D is the one that actually is quite explicit. This is US data, by the way, not IFRS data. Okay, now looking at the variation in profitability. Now we have various metrics here. It's a very nice table in the paper. We look at, here's the one with the interdecile range, okay, which is a measure of to the extent to which the realizations are in the extremes. Lower than the higher than the 90th percentile and lower than the 10% percentile. Relative, standardized relative to the median. You have to standardize here relative to the median. We also looked at we look at, I think I've got a slide here for Moore's kurtosis, okay? We have a skewness measure. We have measures for upside potential versus downside risk. As it tells you about, you're more likely to get higher upside, or you're more likely to get higher downside. These are all in the paper. So the only ones I've given you here are, in fact, the interdecile range. And you see that from the high matched profit margin asset turnover mismatching to the low portfolios are here, you get significant differences. But again, it's this one here that is important. Within each of the 3x3 portfolios for matched profit margin asset turnovers, the multiplier discriminates in terms of the interdecile range. There's results with the Moore's kurtosis. Not quite, it doesn't come up quite as strongly. So there's the variation, okay? You're likely to have, with this measure multiplied, you're more likely to fall into the extremes. In my mind, that's the way to think about investing. One of our problems with Sharpe ratio, we think about standard deviation, but that's not how it works. We know that outcomes are thick-tailed, and what you want to think about, what's the chance I'm going to actually fall way in the left tail? Usually it's the case, if the chance I fall in the left tail, there's also the corresponding compensating payoff that there's a good chance I fall in the right tail, okay? And that's R&D. R&D can actually, put you on the left tail. You don't make it. But actually, if you really get that cure for cancer, man, you're going to be in the right tail. Okay, so there's the kurtosis. And then we look at earnings betas because there is considerable research that looks at earnings betas as measures of risk from the financial statements. We see here that typically you get this statistic, although typically it's within the high match profit portfolios and asset turnover portfolios, in the high ATOs, asset turnover portfolio. And again, just the definition of an accounting beta is the match profit relative to the price of the operations, the market price, relative to the match profit relative to the price for the whole market as a whole. So it's a sensitivity of my match profit to movements in the match profit for the market as a whole. It's an accounting beta. So come to variation tests, run the same thing, and we see the same sort of regression test. We see the same sort of predictions in terms of variation, okay, for the match expenses to sale, and also for both the quasi-match and the particularly importantly for the R&D, okay. That'd be very nice to run this on IFRS and separate R&D as IAS 38 does. Obviously, the financial statement analysis varies under IFRS, and be very nice to compare. Do this study where there's the financial statement analysis under IFRS actually is discriminating relative to GAAP, as Paul Zarowin suggested it might. Okay, so predicting returns. I'll move on pretty quickly here. These are the same portfolios with returns. It doesn't seem to be much here within these portfolios here. There doesn't, the T statistics here are not particularly strong within the portfolios. Except when we come to actually discriminate on the multiplier, we do get some marginal significance for the high match profit margins, but it's not strong. It's not strong. When we do the regressions, it comes up quite a bit stronger, which makes you wonder a bit. These regressions, always staring at these T statistical regressions, always. By the way, these regressions, I should have mentioned this. They're sort of what they call Farman and Macbeth regressions, run cross-sectionally every year, okay, with the coefficients, the means over years, and the standard errors estimated from the time series of coefficients. They're not this mixed panel data stuff, okay, which I don't particularly like. I like Farman and Beth because it's only 40 observations versus 200,000 observations, okay? And observations tend to give you high statistics. But it comes up here. The sniffing thing here is now it's denominated, each measure is denominated in the price of the net operations, which is the way to run a regression in the sense that the accounting variables are denominated in the same thing as the dependent variable. The return is relative to the price of the net operating assets. And so when you have that consistency across the dependent variable and the explanatory variables, then you get that statistical significance. Okay, return betas. Yes, we get return betas. Again, not particularly strong, but particularly on the high profit margin portfolios and the high asset turnover portfolios. And then I'll stop here pretty much now. You're worried about, because we accumulate profits over a number of years, for up to 4 years, although the results are the same just for 1 year here, but there's always survivorship bias. So this table is a analysis of the survivorship rates or the non-surviving rates for due to delisting and due to delisting, and it shows that actually we get the delistings particularly with those that when it's acquisitions, it's because they paid off well. Okay, when it's not acquisitions, it's because they didn't make it, and of course a lot of R&D firms don't make it. And here's the same thing with the delisting percentages within the portfolios, partly due to bad performance on the left-hand side and due to acquisitions on the right-hand side. Okay. Okay, there's my conclusion then. Our conclusion. Financial statement analysis. When we're investing, we're concerned about payoff, expected payoffs, and the risk to payoffs. Here's a financial statement that gives you expectations of the future profitability, match profit, as in the standard deeper analysis, but also the risk in the denominator. And this is reflected in returns and the risk to returns. So this is a comprehensive financial statement analysis that deals with both the numerator and with the denominator. And it all comes from the recognition of how accounting conveys risk, okay? And the properties of accounting conveying risk. That's built into it. It revises the financial statement analysis. Like the Lintner ratio, like the Farmer ratio, it gives you both aspects of the discount rate, the risk and the expected payoffs. And it's comprehensive with respect to what an investor wants. So that's it. I'm over here your questions. Oh, by the way, let me be very crude and tell you about my latest book with Peter Pope, Financial Statement Analysis and Valuation. It'll talk about that there, okay? It doesn't go into great depth because there's a lot more to done here, okay? But that just came out a couple of months ago, which is an update to a more modern financial statement analysis, particularly applied to value investing. Okay, that's it then. Thank you very much for your attention. And I'm here to try to answer any questions you have.
Yeah, thank you very much, dear Professor Stephen Penman, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question.
Well, first, Steve, it's great to see you. I haven't seen you in a little bit.
No, okay.
Last time you came out to Georgia State, but before that, in 2001, you came out to Syracuse, and I started using your book in my financial statement analysis.
Okay.
And just so you know,
You got the new one too, okay.
I got the new one. So
well, I hope you like it, but I hope more that your students like it. This is most important.
I'm sure they will. So I just have a really quick question, Steve. When I was using your book, we would use all your valuation models, and every one of them would provide a valuation that was about half what the actual market value of the share price was. And I just said, well, that's because we don't have good accounting measures for intangible assets. So have we gotten any better at doing that?
Well, if you're quite right. If you actually treat these expense investments as expenses, okay, you're going to get a lower valuation. You've got to separate them out. Okay. So that's saying you can't think of our profitability, RNOA, as a return on investment. Okay. Now, another reason, of course, why you might get half the valuation is the market's mispricing, and that mispricing can be particularly sensitive when there are intangible assets. Okay, so I think that would be the answer. In the new book, we take a very different approach. Rather than doing valuation, we say, okay, let me estimate what the no growth value is, and let me then ask what the growth that the market's putting on, okay, on the growth rate. And what comes into that is, of course, the intangible assets and how they're likely to pay off and the risk to those intangible assets.
Great. Thank you very much.
Okay, NASA.
Hello. Thank you so much for your presentation. I really enjoyed it. I was just wondering if you thought about any implications this might have for investors, like in terms of how they actually develop their portfolios.
Well, I think in the analysis here, we develop portfolios and say this is how you should think about your investing. I think it has immediate application to investors. If you're interested in risk, first thing is don't take accounting profitability as the measure of profitability. I know many value investors, including some in the value investing program at Columbia, some here in New York, who say, I will never buy firms with low profitability. I always want to see high profitability. Now you've got to be careful. They would never have bought Amazon because for 20 years, it had low profitability. It had negative earnings. Why? Not because they were unprofitable in terms of their e-commerce business, but because they were expensing every year. He's going into something new, some new investment. It all gets expensed. If you go to the income statement for Amazon, there's a huge line. They call it the technology platform investment or something or other. It's huge. You've got to strip that out. Okay. So I say to those value investors, well, listen, you can say I only invest in firms of high profitability, but you would have missed out on the Amazon. it's a firm that had low profitability for many years, but the potential to have very high profitability. Mm-hmm.
Yeah.
Now, you're buying Amazon, you're taking on that risk. But I do think this has immediate implications for practical investing.
Thank you. Thank you so much.
I mean,
yeah, I guess your model presumes or assumes that income smoothing or big bath or any of those kind of things are mean equals zero. Would that be correct?
yeah, I mean, this is, you're quite right in pointing this out. This is just taking the numbers as they come out, okay? Now, that says, okay, well, you've got to watch out. There could be some earnings management here. There could be smoothing. There could be all sorts of things going on. There could be excess expensing that generates higher profits. That's not in it, okay? And so what you're suggesting is, hey, you can go deeper on this, okay, and deal with these other issues. But in my mind, this is the top level issue, okay? And then you can think about these other issues which determine earnings, smoothing, earnings management, and so on.
Hi, Steve. John Hand here. How are you? Good to see you.
Oh, well, good to see you, John, too.
Question is, you frame this very excellent analysis in terms of a comprehensive approach. I'm wondering where you think about earnings management or accruals, deferrals management coming in. And I ask the question because let's take R&D. If you expense it, then there is no accrual or deferral management to go ahead. And so if you were to capitalize it or with regular non-R&D expenditures, etc., you do have that possibility. So earnings management here, so to speak, is not uncorrelated with the mismatching. So I'm just wondering to what extent you think it's a first order effect or a third order effect. Just curious on your thoughts connecting in with the earnings management literature, etc.
Yeah, I think this, I see this as a first order thing to look at, okay? I think what you do is you work on principle, okay, and get the financial statement analysis. And then you ask the question, what's the quality of the accounting involved, okay? I think that becomes a qualifying investigation, okay? Is it now the case that there's earnings management going on? You could reverse the order, of course, and say, okay, I only want to deal with quality financial statements, so I do the quality analysis first. So the question of what's first order and second order, they both have to be done, okay? And it's always the case. If they're screwing around with the accounting, that really disturbs us, okay?
Yeah, thank you. And I guess the point I was looking for me to sort of chip in is that it's not an uncorrelated situation necessarily.
No, it's not an uncorrelated situation, no. If you expense the R&D, then you can obviously you cannot fiddle with amortizations, okay?
Right. Thanks.
Steve,
although there are some issues on R&D because there actually is some it's not just cash R&D, it's not just cash, it's buildings that go in there and depreciation on buildings. They actually go on the R&D number. It's not entirely cash. So there's some issues in the background there.
Steve, can I help with John's answer? John's question?
Yes, most certainly. Please do.
Yeah, so John, that's a really good point. So I don't know if you saw my latest paper, but so I found both cross-sectionally and intertemporally, I'm using UK data after they switched to IFRS, that there was tremendous amount of variation, both across firms, even within an industry and a given firm over time, in the percentage of the R&D expenditure that they capitalized. Now, it's certainly possible that they can change the capitalization rate to quote unquote manage earnings, right? They don't want to expense as much, so they start to capitalize more. But as I said to Steve before, despite that potential earnings management, I did find very little in the way of write-offs. In fact, Steve was very helpful to me in a conversation we had not long ago. I found fewer write-offs of capitalized R&D over the same period than I did of PP&E, right? And nobody challenges capitalization of PP&E. So while, you figure that on some level there has to be some gaming of this in earnings management, by and large, it doesn't seem to be that big a problem, at least for the sample I had. The UK is, obviously first world, with the possible exception of the United States, certainly one of the most sophisticated capital markets. I don't know have you seen that paper, or should I send you a copy?
Oh, please send it to me. Sorry, I haven't seen it. My apologies.
Will do.
But it's also interesting, because if there's no writer, so they're probably being very conservative, okay? That's sort of in the spirit. Even if they're allowed to capitalize the D, they're being very conservative about it. Mm-hmm.
I think there is that. I think there's this misunderstanding that the only way to be conservative is to expense everything. Where IFRS, yes, it's not as conservative on the balance sheet as US GAAP, but I think we can still call it conservative. But I'll send that to you.
It's also the case that, if you do capitalize, then you've got amortization, and that's going to hurt your profit in the future. It's like the goodwill thing. You put it in goodwill so you don't have to amortize. Okay.
Right.
So that may be determined, and that may be part of the earnings management story.
Would be interesting to find out if it's the firms that are conservative, or is it their auditors who are insisting they be conservative?
Yeah. Mm-hmm. Yep.
Could I check one more question? Oh, yeah. Sorry. Just one more question. So, Steve, maybe through the center, etc., do you have any sense as to what CFOs do, or how they think about the issues you've so nicely laid out here? Because they obviously have to connect in FSA and V, right, together. And I talk to this a little bit about my students and the cases we do. But I'm just curious as to what your experience has been with regard to the internal FSA V, so to speak.
Yeah, I don't have much insight into it, John, but except there's a tendency for CFOs to say we should capitalize intangible assets to make our balance sheet look better. Okay, and my pushback to that is, well, go ahead, but you may have an impairment next year when you do that. I think in that community and my experience is very, very limited. And there are academics, of course, who say, "Oh, they all should be capitalized." Okay, but the pushback about this. Well, you're doing R&D. The probability is not going to pay off. If that payoff is only 10%, well, the 90% probability that next year or 2 years down the line, you're going to have an impairment. But people tend to think of getting the balance sheet right. This intangible assets here. If tangible assets are on the balance sheet, why not intangible assets? Okay, and it's a very good question. And IFRS says yes, they can be on the balance sheet once they meet a threshold of probability of payoff. But if you find CFOs that really think about the accounting, let me know. Introduce me, will you?
Hi, Stephen. Can I ask you a question, Suresh Govindaraj?
Yes, Suresh. How are you?
How are you, Stephen? Long time.
Oh, it is a long time. Hey, we should get a dinner together, mate.
Yeah, but my video is not working. Can I have a quick question in terms of the theory that I read the Shaojun paper a long time ago, and this has always been a problem for me. We talked about the consumption cap, right? That's where the modern economics is. Financial, right? So how do you look at accounting variables? Are they state variables or they control variables? And this goes back to John's question, everybody else's question. And the connected question is, there's so many frictions. So unless you have the pharma models and stuff like that, completely ignore all the frictions in the market. The question is, how do you treat these variables? Are these accounting variables state variables, or are they control variables?
Well, I'm a bit at sea, I got to tell you, Suresh. I'm working with a guy by the name of David Johnston, who's a Bayesian in Australia, who's thinks about asset pricing very thoroughly. And I encouraged him to work on this problem. He's a finance guy. I'm feeding sort of the accounting intuitions to deal with these things, how you actually get accounting as it should be in a multi-period consumption-based asset pricing model. Okay.
Right. Exactly.
And of course, the question, well, once you do that, you got to get to intertemporal capital asset pricing model of the vein of Merton and so on, where
Right.
it's exposure to the market portfolio, but you want information about states to actually get the idea of how you might form your hedges.
I mean, correct me if I'm wrong. The holy grail should be how to get the pricing kernel in terms of the variables, the earnings and other things like that, the representation. Right?
That's right. To express that in terms of now, in terms of, I mean, if you go back to Feldman Olson way back 1999, they write it down, okay? But the problem there is, as I said before, it's just there's nothing put on the table as to what earnings and book value are. So it could be random numbers, okay? It's just math going through. You've got to get specification to how the earnings and book values are measured to get getting it to hit the road.
Yeah, I mean, the fact that people brought up earnings management, that kind of signifies that earnings are actually control variables rather than state variables, right? If you can manipulate control variables, then you have to optimize the managers, whatever that thing is.
I guess so, yes.
Because it's
yeah. I mean, the whole finance is a bit mysterious to me because we start now. You think about going back to Rubinstein. We start with somehow or other. We know the state space. We know the implicit prices in every state and every time and every event in time. It's a bit a strong rationality assumption, and we just get it going. But these things got to come up. There's some work done by a woman by the name of Emery and John. What his second name is he was at Chicago also on actually trying to endogenize this. Okay, but that seems we in accounting we start with the no arbitrage general asset pricing model of finance, but that's really it's really strange.
I think you have to go the other way around. You have to show there exists no arbitrage with all these problems, not start with the no arbitrage model and then put the state variables in.
Yeah.
The other way around. You have to solve for the no arbitrage equation. And that would be pretty scary with all these things,
I think that way it probably works in the end. You don't have these dividends under states and time, okay? You actually it's the accounting that you get hooked on, okay? But that's very complicated because it can be.
Exactly.
Yeah.
Thanks.
Okay.
It's a pleasure. Thank you.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Stephen Penman, for your contribution and your effort. Thank you, everyone, joining us today, and thank you very much for taking the time to present to us today, dear Professor Stephen. It's been appreciated. Thank you very much.
Thank you very much.
And I hope to see you soon in Egypt. You are very, very welcome.
Okay. Not this year, but maybe I'll get there. Okay. Bye-bye.
Bye-bye.
Thanks for everyone for attending.